think it depends on where you're looking for exuberance. If you're looking at institutional investors, you are absolutely correct. There's really no signs of exuberance. We can see in that Deutsche Bank consolidated equity positioning, you're just slightly above overweight.
Yeah.
If you look at discretionary investors, they're at neutral, which means that people who aren't just trend followers have been sitting more on the sidelines of this market, not going all in. The contrast is with retail investors. Retail investors are very much all in on this market, whether you're looking at Fed flow of funds, AAII, margin loan balances, all of these suggest that retail has definitely pushed all the chips to the center of the table.
Starting to get into the teeth of earnings season this week, Cam, what have you seen so far? What do you think the market maybe needs to see?
I think one of the key stats to watch, and as it progresses, we've only seen about 13% of the names report, but of those 13% of names, what we're seeing is growth is coming in at 8.2%. That's effectively equal to the 8.3% that people expected going into the quarter. That's a contrast from the last two quarters where you had beats that were so large that you ended the quarter with effectively double the growth rate than what you expected going in. So that's probably why we're seeing this market more shrug in the face of these beats versus dancing with joy like we saw in the past couple of quarters.
I get all my stock tips from Nathan Hager. That's why I'm in the triple leveraged all cash fund. And Nathan just mentioned Kimberly-Clark. So I looked it up, Irving, Texas. We all know the name. Last 10 years, it's gone up at 3% per year. It's basically, to be polite, a failure. Okay, fine. Institutional ownership of Kimberly-Clark and the Bloomberg, 87%. Institutional ownership of Apple, 68%.
Yeah.
That doesn't make sense, does it?
Well, you know, I think part of that is the function of people going down the list and checking the box and owning everything in every single sector, where just because they're having to benchmark to a certain index. And consumer staples are one of those things that we think that you should think of them in more of an episodic kind of way. And what I mean by that is they provide protection to portfolios in a short period of time, meaning when things really start to get squirrely in markets, that's when you see consumer staples outperform, but then they give it all back up. So when you think about retail investors who might be wanting to shoot for growth, that's probably why you see that
Okay,
skew.
but is Apple under-owned? I mean, we're going into major tech. Paul, you said Apple's like this week, right?
No, they're coming up a little bit. Yeah, they're this week, along with Meta, Microsoft, Tesla.
They're all under-owned. I mean, that's a fact, right?
So not necessarily. If you go back to November, late October, what you saw in the positioning data is that mega-cap growth in tech had some of the highest positioning exposure by institutions going back over the last few years. And what they were really underweight was cyclical areas of the market. And that explains why you've seen this weakness within tech and big, huge rallies in industrials, energy, materials, because here's the kicker. A lot of these tech areas have very deep liquidity and they have very large positions, but the smaller, more cyclical areas aren't nearly as liquid. So a little bit of money coming out of tech going into these smaller areas is causing this big upside.
I asked Ed Ludlow, Huggies, Kimberly-Clark, it's a cyclical.
Oh, yeah. Well, he's all in there with that household. So, again, we're going to get a lot of the big tech names, Meta, Microsoft, Tesla, Apple this week. How important are those names to this market here?
Incredibly important, simply because there's such large weights in the index. And the question will be, does the top line growth and margin expansion of their core businesses still allow them and give them the free pass to make such large investments in AI, which are arguably not part of their core business yet? You can't argue that Microsoft's making a lot of money off of AI at this point. We've all used Copilot. We all know it doesn't work very well. So I think that it's the core business that we have to watch really closely, because that's effectively what's allowing them to spend so much other money in these newer areas.
We're going to hear from the Fed this week. How does that factor into kind of how you're viewing the market here? It almost seems like, the Fed's 1 or 2 cuts this year. That's kind of it. Let's focus on earnings and other big things.
Look, I think that if there's one chart that could surprise people the most, and this is not our base case, but the one chart is the 2-year Treasury yield. The 2-year Treasury yield is, of course, very sensitive to expectations about Fed policy, and it has been in a very, very clear downtrend over the course of the last 3 years as we pivoted from a Fed that was tightening to a Fed that was easing. That has added to market liquidity, that has kept financial conditions easy.
Right.
If that starts to turn, meaning the market is sniffing out potentially stickier inflation or not as many Fed cuts to come, I think that's a pretty big sea change for risk assets.